And oh, you're on it. Okay. All right. Well, hello, everybody. Welcome to another session of the Microstructure Exchange. Today, we're very happy to have Simon talking about investors as liquidity backstop in corporate bond markets. And Simon has requested that questions be held until the 15-minute mark and the 30-minute mark. He'll put in 2 pauses at those points. But if you have questions that are more clarifying questions, feel free to ask those live at any time. And then also 2 of Simon's co-authors, Carole and Thierry, are both here. And so maybe they might be able to handle some questions in the chat as we go. All right, so without further ado, I'll hand it over to Simon. Please take it away.
Thanks, George. Thanks for the introduction, and thanks everyone for joining online to listen to the presentation on our project Investors as Liquidity Backstop in Corporate Bond Markets. This is joint work with Carole, Melbourne University, former colleague Billy Ford, who by now went to the private sector, and Thierry Foucault at the HEC. So as the title suggests, this project is broadly speaking about clients that provide liquidity in the corporate bond market to dealers. And why we are looking into this topic, to give you a bit of background and motivation. You might be familiar with that there's now ample evidence that dealers have become more constrained after the financial crisis to intermediate in fixed income markets, bond markets, and corporate bond markets in particular. And at the same time, we have seen huge growth in these markets. So if you take these things together, then you realize that there's a greater risk of liquidity evaporation in times of market stress. And we've already seen empirical evidence of that. For example, March 2020, the dash for cash, as well as in the UK, the ADI crisis, which was more focused on the government bond market, but also had spillovers into the corporate bond market, actually. And also, if you look into the media, it's not difficult to find headlines that talk about, worries, concerns about corporate bond market, illiquidity or liquidity, going back to, as early as 2015, or probably even earlier than that, but that is still ongoing debate. And just in case you're not very familiar with the bond market, just to make the point that it's an important market, we've seen a steady growth in the amount outstanding, and especially since the financial crisis. If you look closely here at the data from the ECB, you see a bit of a shift in that trend even. So the corporate bond market following the financial crisis has become even more important. And the lower graph, if you look at that is from a recent, not so recent anymore, 2023 Financial Stability Report by the Bank of England. You see that by now, debt securities basically make up 40% of UK corporate debt. So it's a huge source of funding for corporates. And so against this background, we ask what is also at the forefront of many regulators, how to make corporate bond markets or bond markets maybe in general more resilient. And one answer to this is, well, the question, to what extent maybe clients be able to step up and fill that gap and provide liquidity and function sort of as a liquidity backstop to the dealers. And that is what we are going to investigate in this project. So we are looking at to what extent do dealers actually rely on client for liquidity provision. Does that access reduce transaction costs? Does it make dealers or the bond market in general more resilient to liquidity demand shocks? And what are the characteristics of clients that provide liquidity? How do dealers manage their network of liquidity providing clients? How are they rewarded? Those are the questions we ask in this project. And in doing so, our contribution is as follows. So we are using very granular, detailed transaction level data on European corporate bond transactions, MiFID II data, which by now you may be familiar with. And the granularity of the data allows us to identify a new trade type of client liquidity support, which we call client-sourced liquidity. And then, having identified this trade type, we investigate how access to these trades affects trading costs in bond markets. And we identify which clients matter most for liquidity provision. And then we have a bit of a theory part as well, where we take the model by Zaid et al. And study how dealers' ability to obtain liquidity via these CSL trades affects transaction costs. And we are then able to derive predictions from that model about the pricing of these trades, which then will give us confidence in that we actually, what we are, labeling CSL trades empirically actually, is what we claim it to be. And we will be able to understand the impact of the size and the composition of dealers' liquidity supply networks on their ability to absorb liquidity demand shocks. A quick overview of the main findings of the paper. So the first thing that I want you to take away is that these CSL trades, they matter. And it seems that they are mattering at most for basically risky and illiquid bonds or time periods. We see that they are more frequent in bonds and in periods with high balance sheet costs for dealers. So we find evidence that they are a valuable tool for dealers to basically manage their balance sheet constraints. And they matter in the sense that they really reduce transaction costs overall. More specifically, and all these things are in line with basically what we derive from the model, is that first of all, on the pricing of these trades, clients that offer liquidity receive price improvements of these trades. And I guess that is actually quite intuitive, I would say. In a way, this is what allows us to also claim that they are liquidity providing trades. And we find that a decline in the size of these dealers' networks of liquidity providers increases transaction costs, and sizably so. Yeah? And that these networks of liquidity supplies help to absorb or to basically cushion the negative effect of liquidity demand shocks. So in these two senses, these air trades really matter and improve market quality, if you will. Something that we stress in the paper is that the composition of dealers' liquidity networks matters. It's not just the size, but rather maybe what you want to call the effective size. So meaning that dealers that rely on clients with more flexible mandates, in the sense that they are able to provide liquidity in a broader set of states of the world, they are more resilient. And finally, the liquidity provision by clients is really valued by dealers, in the sense that not only do these clients get discounts at the moments where they provide liquidity, but their past provision services gives them benefits in trading across the different trade types. So even when they seek liquidity, clients get revalued for their past liquidity services. And this is distinct from overall trading relationships. Quickly on the literature that we are speaking to, only the two main strands of the literature. So there's one part that talks about agency trading, so-called match trades, if you're familiar with the literature. And then there's obviously already some evidence on liquidity provision by different specific client sectors, mutual funds, insurance companies, and hedge funds. So what we add here to this literature is that one thing is that we sort of have a high frequency identification of liquidity provision. In many of these papers, that is not so directly possible. So these papers talk a little bit more of how clients react to basically low frequency price pressures, which clients trade basically with the inventory cycle, or which trade against the inventory cycle. So it's a little bit more about sort of contrarian trading. And on the other side, the papers that do have a bit more of this high frequency approach, if you will, which are the papers by Choi and Goldstein and Kaga, they speak about a different trade type, and I will be more specific about this in a second. That these CSL trades are not quite the same as what you may know as riskless agency trades. And then naturally, given that our data allows us to see the whole cross-section of market participants, that then allows us to go more deeply into understanding how the whole network of dealers' liquidity supplies affect transaction costs, and which clients actually matter most for liquidity provision. Naturally, we discussed the papers in more detail in our paper. Okay, 10 minutes in. On the data, as I said, we are using MiFID II corporate bond transaction data, which has the usual characteristics of transaction data. In terms of the scope, what we're covering, it's in a way not just the UK market, but really everything that is either traded in the UK or with the UK supervised counterparty. And this actually includes a lot of European denominated and EU issued debt as well. Also some US, actually quite a lot of US dominated bonds. But the real important part about this data is that we have the client identifier, not just the dealer identifier, which you may know from the trace data in the US. Then we pair this data with data from Capital IQ and Refinitiv to get additional information on bond characteristics such as ratings. And then finally, the sample that we're covering here is the 3rd January 2018, which is when MiFID came into effect up until the end of 2023, which is basically when we started this project. Quick overview of what we have in the data here. 18,000 clients, roughly 40,000 bonds, 52 dealers, and 6.6 million trades. So really quite a bit of heterogeneity. As these averages here, just to give you a bit of a flavor, if you're not too familiar with that data. So we find that, for example, on an average dealer day, a dealer would trade with 46 different clients, roughly in 70 bonds, and execute around 100 trades. On the client side, those averages are naturally much lower. Clients on a given day where they trade on average would trade with only 2 to 3 dealers. That is driven by a right tail of clients. The vast majority of clients would only trade with one client. And similarly on the bond side, corporate bonds, very illiquid. So on average day would only trade 2 to 3 times on a given day, and that is sort of conditional on being traded. Most bonds don't even trade for a month or even more. All right, so much for the setting. Now quickly towards what we actually mean by these client-sourced liquidity trades. The method here follows very closely that of Choi in the management science paper, where just imagine that you observe at a given point, T1, you find that a client trades with the dealer in any direction, buy or sell. And then at a later point, but still on the same day, you find that the dealer trades in the opposite direction with another client. And there's really no other trade in between. There's no interdealer trade between T1 and T2, okay? Then we would call this pair of trades a CSL trade, client-sourced liquidity trade, which consists of a first leg and a second leg. For completeness, it may actually be the case there could be more than one client in either of these legs. That's totally fine. But naturally, the second leg of a CSL trade cannot be the first leg of another one. Yeah, so you really a strict pairing. And the point that we are going to make is that the second leg in these CSL trades, they basically provide liquidity to the dealer. If you're familiar with the literature, an important point is that we really distinguish between cases where basically the first leg and the second leg happen instantaneously. So where the dealer is, matching two clients that want to trade in the opposite direction. These are typically pre-arranged trades, riskless agency trades, which are talked about in papers such as Choi and in Kaga. But we will show that these are really different from moments where T2 minus T1 are strictly positive. We will make another distinction here. We talk about this a little bit more later, where we distinguish between fast CSL trades, which are moments where it takes less than 15 minutes for the dealer to unwind the previous trade, and moments where it takes more than 15 minutes, and these we would then call slow CSL trades. And now to make the point that these CSL trades are really, you should really think about these to be different from being prearranged, even though the time lag between them is pretty short. One thing is that what I actually don't have in the presentations, that we have some regulatory evidence on that, which is that there's a trade capacity flag in the MiFID data, where the dealers themselves basically report when they use their own balance sheet and when they don't. And the vast majority of our CSL trades are instances where dealers themselves declare to have used their own balance sheet in the trade. And that is not the same for our match trades. But they're also quite different economically speaking. And maybe I just finish this, Josh, and then we have a bit of questions, which is that these CSL trades are associated with riskier trades. They are more frequent in lower rated bonds. As you can see here, high yield, for example, 48% of fast CSL trades are in high yield bonds, which compares to only 30 and 33% for matched and deal trades. And they are much more frequent in larger trade sizes. So block trades, 16% of CSL trades are block trades. Compare that to just 6 and 8% for matched and deal trades. And then finally, we also see that these fast CSL trades react, they spike in crisis periods. If you take the dash for cash, you see the orange line here, a spike in CSL trades. The same for the invasion of the Ukraine, which triggered a commodity crisis. It ticks up during the ADI crisis, as well as in the banking crisis of early 2023 with the failure of SVB and Credit Suisse. And then, I don't know, maybe maybe I can pause here just for a second.
That sounds good. Thanks, Simon. Does anyone have any questions? Maybe Simon, while we pause for questions to accumulate, maybe I can ask you one. In your definition of CSL trades, I remember one step was that the dealer doesn't do anything in between the two legs. And I was just wondering if you could say a few words about why you think that's important. I mean, I would kind of think if I'm a dealer, maybe it's a busy day. I still want to source some liquidity, but something happens in between.
Yeah. So the motivation is to be able. So when I say that the dealer doesn't do anything in between, that is what I mean is in the same bond. So the dealer may trade still other bonds. It's really just in that bond, so that we are able to really link first leg and second leg directly with each other. So that's the main reason.
Okay, that helps. And then I see we have a question from.
Hi, just a question. When we were talking to FINRA and dealers in the US, it seems that their choice of whether to mark something as riskless principal or agency had to do with all kind of relationship with specific clients and stuff like that. So whether it will be in the US, looked like a match or a fast CSL, did not seem to be so much economics in general, but relationship. Do you know of any such evidence in the UK?
No, I'm not, and I would be a little bit surprised if these considerations would play a role in the way they would report their trade capacity flag in the UK or in Europe, because there are clear regulatory definitions about these things. So I don't see a reason why they would do that.
So just what they told us, that some clients wanted to basically account it as a fee and others as a markup. And fee for agency and markup for principal versus principal, that was the difference. But you say that you haven't heard anything like that. Okay.
Yeah, I think it also probably doesn't matter that much, because that fee versus markup thing doesn't really matter in this data because it's not reported. So there wouldn't be that kind of motivation from a client side that they would basically ask them to report a specific trade type. But in the end, we are not using the trade capacity flag anyway. We just used it as a check, basically. To what extent we can really think of these two trades, matched versus what we call CSL trades, to be different. And that was one way, but the more important thing from our side is that we clearly see differences in the economics of it. That is, I think, the more important bit of it. Yeah. All right. I think then maybe I continue. So the whole goal of the study is here to look at the effect of these trades on transaction costs. So we need to measure transaction costs, and we do so in the standard way, the log difference of the transaction price to the benchmark price, which we take also standard to be the closest interdealer price prior to the trade in the same bond, but not older than 24 hours. And then that is multiplied by the trade direction of the client, 1 for buy minus 1 for client sell. And we measure the whole thing in basis points. And to give you an impression of the time series dynamics of deals versus fast CSL trades, you can see that on average they evolve quite similarly, with spikes during crisis times, particularly dash for cash. But then if you look at the different legs of the CSL trade, you find that the second leg is really much cheaper than the first one, and we want to understand why that is. So yeah, as I said, so we want to explain the pricing of CSL trades and understand why the second leg is cheaper than the first one, but then also how the possibility of this to rely on liquidity provision via these trades affects trading costs. And this is then where we first turn to theory and derive from that a few testable implications. So yeah, we build on your model. Yeah. In the, I think, RFS is it, the journal, and all we do is we take this and we add CSL trades. So that means that we have 2 modes of execution when a client contacts a dealer. Call that client C1. We have market making, which is immediate execution. The dealer receives the spread, but incurs balance sheet costs B if she doesn't unwind her position. And this unwinding is what we're going to add to the model. And then the other mode is matchmaking, riskless agency trading, where the client pays a fee, the dealer searches for a counterparty, so the client pays a fee and also has waiting costs, because it doesn't get immediate execution, but the dealer pays search costs, and as a benefit of that, however, does not have to bear the balance sheet costs. In equilibrium, the fee is smaller than the spread, so the trade-off for the client is really trading costs which are larger with market making versus weighting costs, which are larger with matchmaking. But what is new now is that for the case of market making, we have these CSL trades, which means that the dealer can contact clients in her liquidity network to unwind the trade. And if a client responds, call that client C2, then the dealer offers to trade the bond at spread S2. And then the client can accept or reject. So this is just what I said in a little diagram. You have the client C1 that has some private benefit from trading U1, and it gets faced with the paying the fee or paying the spread. And if it chooses matchmaking, it pays the fee, and then gets the payoff delta times U1 minus the fee. So delta is here the basically weighting cost. The lower delta, the higher the weighting costs, and the dealer gets the fee and pays the search costs I. And then on the other side of the tree, we have that if the client chooses market making, it pays the spread, but then the client, the dealer, can contact the liquidity network with probability alpha. A client responds and then gets offered to trade at spread S1.
Simon, I think we don't see the diagram.
Oh, you don't see the diagram? Okay. But you can see the slides. Can you see that?
Yes, we do, but I was not seeing the diagram.
Okay.
If you go back to the previous slide, I see.
Yeah.
Okay, fine. But I hope that the previous explanation was clear enough. The diagram was just sort of a second way of presenting what I just said. Few remarks, which is that the private benefit U2 for the second client is also drawn from a uniform interval. You may think this is like a technical difficulty, but I will mention that later again, that actually you have to think about why does the client actually trade in the second leg. I will come back to this later. And in the model, it's just also the second client has some private benefit of doing that. And then alpha you should think of as the probability of the dealer that to find client to be willing to trade the bond, and it's a combination of two things. It's basically the size of the network, which you may think of as the number of clients in that network, but also the probability of each single client in the network to actually be available for liquidity provision. So in that sense, alpha is determined by both the size and the composition of the network. Okay, so we solved then this model by backward induction for the spread to both clients and the fee. But I will not go into this due to time constraints, and just tell you about the hypothesis that we derive from this. The first one is on the pricing. So the first leg in a CSL trade should be more expensive than the second leg. And then on the importance of these trades, we find that an increase in the probability of obtaining liquidity from clients, that the transaction costs in that bond would be lower. And at the same time, the positive effect of an increase in the dealer's balance sheet costs on transaction costs, so balance sheet costs go up, transaction costs go up. That effect is smaller if you can rely, if you have a higher probability of obtaining liquidity from your clients. So your liquidity client network, is a cushion for absorbing an increase of balance sheet costs. Okay, so what do we find in the data on these hypotheses? To test the first hypothesis, we simply regress transaction costs on our dummies for our CSL trades, and controlling for other trade characteristics such as the trade size, client share dummy, also a dummy for these match trades, and a dummy for algorithmically executed trades. So given that we also have the match dummy in here, that means that the baseline for this regression are deal trades. So all of our coefficients, are interpreted as, relative to a deal trade. And we account for a bunch of fixed effects, in particular dealer day, client months, bond day, venue type. You already saw that these CSL trades, they are more frequent in riskier bonds. So naturally, you have to account for bond characteristics and all these other things in order to not have your results biased and be driven by these observable or unobservable characteristics. And what we find is in line with the theory. So indeed, the second leg gets a discount of roughly 4 basis points. So we have that actually an average deal is about between 9 and 10 basis points. So a discount of 4 basis points is quite significant. Note that for these slow CSL trades, we do not really find a discount, and this is why we sort of separate between them. We have played around with sort of different time thresholds, and look like that after 15 minutes threshold, we don't find a significant discount anymore. This is why we made this distinction between them. Also note that the first leg of CSA trades is more expensive, while match trades previously talked about also receive a discount. From these results, there are a couple of questions that you may have. Let me preempt some of them, but I think regarding the time, we should discuss them maybe later. One thing that you may think about is, well, given the discount on C2, why does the dealer not trade in the interdealer market then? Yeah. But note that the CSL trades, they are still trading at positive transaction costs. Yeah? And the way we are measuring transaction costs with the interdealer price as the benchmark, that means then that actually, the client fares better trading with the client than in the interdealer market. Okay. Given that the spread, however, for the second client is positive, you may wonder, so why does the client even trade in the second leg? And maybe we can discuss this a little bit later. But one thing you can think about is that, the client would have basically traded anyway that bond at some point. The dealer knows its client base. It understands, the interest of different clients for a given bond. And so, approaches that client. The client understands that this is a cheap trade. And so it just executes the trade at an opportune time, but might have done that anyway, just as an example. And maybe a little bit of a bigger picture question is, to what extent is this then really liquidity provision? If you are, maybe coming more from the order book literature, where you would really clearly associate mechanically that the liquidity demander pays the transaction costs, so transaction costs should be negative, then you may wonder about this here. However, it's more the timing of the trades here that tell us that the dealer is really initiating the trade and wants to execute the trade. But then in the OTC market, the price is still determined by sort of niche bargaining. The dealer has market power, so it doesn't mean that the transaction cost should be negative just because the dealer is the one approaching the client. It's already quite meaningful that the trade is cheaper than it otherwise would be. Yeah. And then, that maybe we can discuss later. Okay, now coming to the maybe a little bit more meaty part of the analysis. So do these trades really matter? We saw before they are making up like 5% of total trading volume. So really, how important is it that you have access to these clients? And to investigate that question, we want to understand, how to track transaction costs develop when there's a negative shock to the size of the liquidity supplier network. From the model, we know that transaction costs should then increase. Okay, how do we approach this then empirically? In principle, I would say, one can think probably of the following. Well, find clients who were unable to provide liquidity on a given day, and then just, measure how important basically these clients were in liquidity provision for a given bond prior to that day. Yeah. Because the fact that they are unavailable would mean that, sort of your liquidity network shrinks by that share that client was responsible for in the past. And you do this, for all the different clients for a given bond, and you sum up their shares, and that is then a total shock size, if you will. We will follow that approach by looking into the dash for cash period. Why? Because liquidity demand was one-sided. Clients were really desperate to sell. So liquidity providers should be those that are capable to buy a given bond. And then the nice thing on top of this is that also, clients selling for external factors, redemptions in open-ended funds, margin calls on US dollar hedges, for pension funds and insurance companies and the like. So it seems to be really a nice sort of laboratory to test our hypotheses. Just maybe to make our identification. Okay, should we take questions actually at this point?
Whenever is a good time for you. There's one from Gideon.
Yeah, let me just finish maybe with the identification, because maybe this raises some questions, and then we continue. So just to make this again more clear, just take any given day during dash for cash, you observe that investors selling, say, asset A and B, and it's really exclusively selling, not buying anything. Look at another asset C, which is traded by other investors, but not investor I. But you observe that prior to dash for cash, investor I was actually making up X% of liquidity provision in that bond. Then we are going to take X as our measure for the negative shock to asset C's liquidity network, and we call this blocked LP. And maybe just let me finish the results, and then we take questions. And then we take that measure and we regress it on transaction costs, and on top of that we are interacting this with the client sell dummy, as we might expect asymmetric effects. And indeed, this is what we find. So first of all, average transaction cost for a sell were like 29 basis points in the crisis. We find that sells were unsurprisingly more expensive than buys during the crisis by about 11 basis points. And now if we look at how much it would have cost if all of the liquidity network was unavailable in a given bond, that would basically be another surcharge on your client sell of 10 basis points. So basically doubling the premium that you already have to pay on a client sell. And reversely, for client buys, everything becomes much more cheaper the more of your liquidity network is unavailable. So a buy, as I said, was around 18 basis points in the crisis. But if your liquidity network was not available, that would come down by another 15 basis points. So basically 80% discount, quite significantly. Maybe some questions.
Gideon, go ahead, please.
Sure.
Okay.
I had a couple of questions. First of all, on the model, because we didn't stop there. Is there a relationship, a hypothesis that comes out of the model that connects S1 plus S2 to 2F? Does it have any equilibrium implication for the sum of the trading in the principal and the agency? So that's the first question about the model. The second one, you were talking about alpha as both the network and the composition of clients in S2. And I was wondering, why don't you think about the U2 as kind of the composition and think about estimating that from data and stuff like that?
Okay, so on the first one, I think your motivation is probably to think about that you could get the matching fee from both of them, client C1 and C2. So just having
in the model, yeah.
Yeah. Okay. I don't know if this really restricts the analysis. I mean, whether you could sort of always include this as a. It seems to me that without loss of generality, I mean that F is basically 2 times. Call it G, and then our F is 2 times G. That would be my instinct, but Thierry may be better able to answer this question. And then your second remark, not sure. I mean, I don't think that we have thought about this. I think, I mean, just to separate these things a little more cleanly, I think that, so certainly, the private benefit of trading should be connected basically to the probability that you are able to trade or willing to trade. But I guess you could separate them as well by just saying, okay, you two should be more cleanly the benefit that you get out of it if you were able to trade it. And then you have separately, the probability that you are able to trade, which may be related to other factors such as regulatory constraints. So if you're an insurance company, you may, have a private benefit of, I don't know, trading a high yield bond, but then the capital charges that come on top of this, constrain you of actually doing that. But I don't know if this is a really good answer. I don't know if Carole or Thierry want to answer that question as well.
Well, this is a very good question. In fact, the interpretation of U2 in the model, my view of U2 is that it may be time varying, so it's not a fixed characteristic of the client. While, for instance, the likelihood that at any given point you are available to provide liquidity might be a fixed characteristic. That's the way for the moment we are thinking about this, but I fully agree with this. The interpretation of the private gains is a bit tricky.
Thank you.
All right. I carry on then. For the third hypothesis, which looks at whether a liquidity network helps to basically absorb shocks to balance sheet costs, we will look at fallen angels. So the hypothesis was that sort of a larger network of client liquidity support means a milder increase in transaction costs following an increase to balance sheet costs. And fallen angels, I think, we think are quite ideal for testing this, because the downgrade very directly mechanically represents an increase in balance sheet costs for that bond. And on top of that, we already know from the previous literature that the price pressure resulting from the downgrade or the selling pressure, I should say, resulting from the downgrade is large enough to test dealers' balance sheet capacity. And first of all, we check that this is also true in our data, and that is the case. So the graph on the left shows that transaction costs overshoot, the overall high yield average at the day around the day of the downgrade. And as an indication of, that again, the client liquidity supply DCSL trades matter for the dealer, we find, that they are used much more frequently around the downgrade window. So it seems, that if they are used, the question naturally then is, how important is it to be able to use them? And to answer this question, we are basically doing a diff analysis. We have two windows, the downgrade window, two periods, the downgrade window and the post-downgrade window. We have two groups, fallen angels and high yield bonds. So, in the first dimension, you simply, subtract from your fallen angel transaction costs on any given day the average transaction cost over all the other high yield bonds, excluding, other fallen angels. That's your first diff. And then, you compare this measure during the downgrade window with post-downgrade window. So simplified, it would look like this. Take bond A. The transaction cost difference to the high yield average is during the crisis during the downgrade higher than it is post. The difference, call it DA. And then you may have a second bond, bond B, where the price impact is not quite that big. And then the question would be, so how does liquidity provision affect really the size of the price impact in any way? So does the share of liquidity provision in the bond correlate with the price impact? The prediction would be it should be negative. And so our regression specification follows that idea. So we regress transaction cost on the downgrade window dummy, and we interact this with the share of liquidity provision prior to the downgrade window. And what we find is rather underwhelming. So we do find, first of all, evidence that there is indeed a price impact, but liquidity provision doesn't seem to matter that much. But this is explained by that the network composition matters not all of your liquidity providers, the usual ones, may actually be able to trade high yield bonds, such as insurance companies. So we investigate then that question by interacting the downgrade dummy also with the share of liquidity provision that was accounted for by a given sector. So, if insurance company accounted for 20% of liquidity provision prior to the downgrade window, then our LREL here would be 0.2. And indeed, we find evidence of that it really matters, who you have in your liquidity network. For hedge funds, the price impact is reduced. So that is basically here the blue line. The larger the share that hedge funds account for in your liquidity network, the lower the price impact. At the extreme, where your entire liquidity network would be made up by hedge funds, the price impact reduces from about 4.2 basis point to just 1 basis point. For insurers, it's the opposite. The price impact gets much, much larger. So that then, motivated us to look a little bit more deeply into who actually provides liquidity. And again, it seems that, hedge funds seem to take a special role here. If you look at how much trading volume they account for in our liquidity providing trades, it's 17%, and that is 7 percentage points larger than their share in overall trading volume. So they are over proportionately active in liquidity providing trades than they are in, total trading, basically. And looking at the other sectors that have been discussed related to client liquidity supply, asset managers, insurers, we don't find the same for them. They are less active in these trades than they are overall. And on top of that, for asset managers, they are more active in actually liquidity seeking trades, such as the first leg in these trades, than they are in the liquidity providing ones. And that is also true during the crisis. During the crisis, hedge funds, so here Dash for Cash, increased their share even to almost 19%. In fallen angel windows, it's also almost 19%. And then we were interested in seeing whether we can basically get out of the data evidence of how much dealers actually value that sort of liquidity provision, in the sense of not only we already see that they give a discount for each single trade, but does it actually how do they manage their network? Do they reward clients that account for a larger share of liquidity provision? So we measure that, the share of clients in liquidity provision to a specific dealer over here a window of 90 days prior to the transaction, called this liquidity service relationship, and at the same time accounting for the standard way of basically measuring volume-based relationships, just to be sure that we account for the case that these two actually overlap. And we find that is indeed the case. At the extreme, where a client would be the sole client in your liquidity provision, so accounting for 100%, the discount would be almost 10%. And we see that this is surviving, both in economic significance terms as well as statistically, when we account for overall trading relationships. And coming back to, are there any differences across sectors? Again, we find that hedge funds are sort of special. Their discount that they get on past liquidity services is twice as large as that is for the next sector. And that brings me to conclude. So firstly, we look at a trade type that I think really hasn't been discussed that much previously in the literature. We call them client-sourced liquidity trades, and we show that they are a crucial tool for dealers to manage balance sheet costs and to mitigate liquidity challenges. That's the first thing. Then we stress that it's really about the effective size of the network, so that is size and composition, which makes up dealers' ability to withstand liquidity shocks, which then in turn shapes overall transaction costs. And we find that different clients contribute differently, with hedge funds here taking a particular role, and that these discounts for liquidity providers are not merely relationship based, but are rewarded, on their own, which potentially, means that is a way for dealers to manage their liquidity network. And then, future research, I think digging a little bit more deeply into how dealers manage their liquidity networks over time. How does, investors' ability to provide liquidity vary over different market regimes? And then a little bit more immediate, I think, is the question to understand what actually motivates a client to trade in the second leg. What do these clients do once they've traded in the second leg? Understanding that, I think, would also be an interesting exercise. That's it. Thanks. Sorry for running a little bit over time.
All right. Thank you very much, Simon. And now we can open up for questions. And by the way, Simon has said that he's happy to stay past the top of the hour in case we have a lot of questions and it takes us past
Absolutely.
that point. All right. Gideon, you're the first one with a hand up. Why don't you take it away?
Thank you, because I have to leave to our own seminar in like 2 minutes. A couple of questions. I actually think that what you mentioned at the end may be important for the paper. So trying to figure out, because even if they pay positive transaction costs, the hedge funds, because they are entering at a time of stress, presumably buying at depressed prices. And so looking at profitability of that position over the next several days, several weeks, and showing how it's different for match FCSL, CFCSL, insurance companies versus HF, and so on, I think would be very instructive to thinking about the motivation of the players in this market. The one additional comment I have, just because of history, right? If you remember the recent Werner papers from the 90s about dealers in London in equity, what they showed that we kind of didn't know at that time is how dealers make decisions of whether to, first of all, look for the other side and then report them together or not. And we didn't know that those games actually existed. I don't know, given that 30-some years have passed, whether those games are still being played. But it may be important to figure that out. That's it for me. Thank you. It was a very interesting paper.
Thank you, John. I think these were more comments, right, than questions. So I mean, maybe just on the last bit, which I think again you are questioning sort of the extent to which the difference between using your balance sheet versus is it truly that, or is it not matchmaking in the end, again, riskless agency trading. And again, I would argue here with the, I mean, one thing is that it's, I think, interesting enough to see actually the differences in the trade characteristics between match trades and our CSL trades. I mean, they're so clearly different. That doesn't mean, again, that, I mean, randomly, right? I mean, could be like that, and they may still be prearranged. But again, then regulation is quite clear about that if it's prearranged, the timestamp must be the timestamp of the execution. So if you have a client that comes to you and wants to trade, but you say no, you have to wait. I find a client on the other side, and at the moment where you find the second client and you execute the trade, for both of them, it must be the same timestamp. MiFID regulation, I would say, is pretty clear on that. And and the FCA is, I think, pretty good at chasing and making sure that things are properly reported. Yeah. But thanks. Yeah, thanks for the comments.
Albert, I think you're next in the queue.
This is Albert Menkveld.
Hi.
This was a really interesting talk. There's so much to it. You did a great job in exploiting many angles here. One thing that might be interesting to also look at, given your data is so rich, is if this is a story of, hey, I'm the relation.
You're breaking up for me. I don't know if Josh, you can hear
Type
me.
of
Oh,
story
for the for you.
that Gideon was mentioning. I'm thinking exclusivity. Can you hear me now? Is
Yeah.
it maybe this is better?
Yeah.
I was just simply thinking if there's an additional traction to the story of I'm a dealer and you're my client and you'll be exclusively there for me if I need you, I'll give you a better deal in the future on your trades. Meaning maybe you can see to what extent a particular client ID always trades with the same dealer. If that is true, then these agents should get better deals in the future, and maybe getting even lower transaction costs. So I wonder if, since you have the data, you could see to what extent are these relationships exclusive, or is a hedge fund sometimes providing this liquidity in the second leg to dealer one, and sometimes to dealer two, sometimes to dealer three. Have you looked at it? But this just a thought. Other than that, I really love this analysis. Thanks for presenting it so well.
Thanks, Albert. Yeah, the whole network thing. I think it's on our to-do list to explore this a little bit more. But yeah, the very specific thought that you had, we haven't looked at yet. And but I think it's a good thought. My prior would be at least for on the hedge fund side, but that may not be true for all of the liquidity providers. Hedge funds are pretty active across different dealers, and this may also be part of why they can actually do this, because they may be able, in a relative value strategy sense, to exploit basically the liquidity shock that one dealer is facing, unwinding the trade cheaply, and then trading that bond with another dealer potentially. But it's definitely something we should look into. Yeah.
Thanks.
Peter, you had your hand up. Do you still want to ask your question?
I do not want to slow the discussion, so it may be looked upon in the comments. Okay.
Okay, so let's go to Faisal.
Hey Josh, Faisal, yeah, thank you. Can you hear me?
Yes.
Yep.
I guess I have two questions. Maybe the first one will be very related to what was said. Basically you showed that these FCSL trades, they tend to increase during the stress episodes, and basically what I'm trying to see is if you could elaborate on whether this increased reliance on these trades, especially in these times of stress, does it lead to systemic risk, especially if these hedge funds themselves face constraints during these periods? So that's my first question. I think it's not related to what was said, but my second question is, how do you think that the fact that dealers offer discounts to clients who provide this liquidity during these periods, how do you think this affects their incentives of in terms of managing their inventories over time, in the sense that perhaps one strategic response to these incentives would be that they want to be there when there is a crisis, in the sense that they want to provide liquidity to dealers when there is the crisis, so that they can have this kind of less expensive transaction costs in the future. And is there some kind of a competition effect between hedge funds to be present when dealers need it? I don't know if my question is clear, but yeah, thank you. If you can elaborate on these things, but.
Yeah. I think so. Only your first question on what you meant by systemic here was not quite clear to me, but maybe let me first answer your second question, which is, I think I would hope, and I do think, that there is some competition going on in the end. I mean, this is coming back to what Gideon said earlier, that even though transaction costs are still positive, but that doesn't say necessarily how far this thing is away from fundamental. And I think that one reason why hedge funds seem to take a special role here is that they are able to basically profit on that and try to profit from the price dislocation, and then at the same time being so much active in it that this is what's coming out of the fallen angel analysis, that the price impact in total gets dampened. So what is it that in the end drives the price impact from being 4 basis points down to just being 1 basis point? I would assume to some extent competition, but I mean that's just a hypothesis. We haven't checked that. Yeah, but could you be more specific on your systemic risk question?
I'm saying that I mean liquidity is there because these hedge funds are, I mean, able to match the trades of the dealers. So my question is, if at the same time these hedge funds are also under stress, what would happen?
Yeah. No. So 100% right. And I think so. Even though we stress here the importance of hedge funds, I mean, the more general point we try to make is that it's about the composition. I mean, sort of by the episodes that we picked here because they are convenient to study, we may get the results that hedge funds are important. In some ways, I mean, this part of the analysis as well seems to confirm this, but in the end, also they face episodes where they're not able to trade, right? These can be generated in the repo market, being funding constraint. These can be because of previous losses. So I wouldn't say that they are so great because they're able to provide liquidity in all states of the world. What is more important, and to exactly avoid systemicness, is that the dealer understands this and manages its network in a way that the states of the world across which it can find clients to provide liquidity, that these abilities across the different clients must be negatively correlated or uncorrelated at least, to sort of ensure that it always has someone to step in to some extent. If the dealer doesn't, and then this is the dash for cash result basically. If that liquidity network is reduced in size, transaction costs will become more expensive. Does this answer?
Yeah, very good. And thank you for the talk, by the way. Very good. Thank you.
Thanks for joining.
And then let me ask a question of my own. So I thought one of the most interesting pieces of what you were doing was where you were trying to empirically quantify the extent to which the ability to pursue this client source liquidity affects transaction costs. And then I was kind of wondering, could you use the model to try to address this as well? I mean, like calibrate the parameters of the model in some natural way, and then does the model give you a number that aligns well with what you're seeing in your analysis? And if so, that might be kind of a nice sanity check for the model, or a nice way of convincing us that the model is doing a good job of capturing what's going on. Just a thought.
Yeah, no, that's a good thought. I think for now, if you take the model, it has I think enough parameters to basically get out of it what in a way whatever we want. I mean, because of that, more and more, and I've been thinking about whether this could be put into something structural, and then trying to estimate this structurally. I mean, it wasn't sort of the idea. I think when we started out with the model, it was more as a sort of device to constrain our thoughts or to inform us. But I agree that it would be nice to get out of the model somehow. Numbers that tell us that theoretically it makes sense that it's important. If the model would tell you it's actually marginal, sure, these trades are being used, but marginally, then that wouldn't be great, I guess. So I agree.
Thanks. All right. Well, unless there are any other questions or comments.
I think there's a question in the chat that is interesting, no? About the correlation between the size and the need.
I didn't see.
By Jakob.
Yeah. So Peter Lerner asked, is there any correlation between the size of the transaction and the client? Thierry did attempt give an answer in the chat, but Simon, maybe if you want to
okay, sorry.
elaborate on that.
No. Okay.
The size of the transaction and the client type. Yes, I'd say there probably is, but it's more like client time dependent as well. So, for example, we know from Gabor's and Peter Konda's paper that when hedge funds are informed, they like to split their trades across different dealers, meaning that in total, then probably they trade smaller trade sizes. Then there are certain institutions that just generally trade in larger sizes because they're sort of with more slow-moving investors. I think probably hedge funds, pension funds, I think are trading in larger sizes than your average client. But is there a deeper motivation for that question, actually?
I don't know.
I mean, I saw, yeah. Would that bias in any way our result? Because we have both client, we take account of the trade size, and we also have client time fixed effects. So. Yeah.
Okay, unless there's anything else, maybe let's wrap up and hope to see you all back at the Microstructure Exchange in another 2 weeks.
Thanks a lot, everyone. Bye-bye.